In 2017, two investors started with exactly $100,000, both chasing the same goal, financial freedom. But by 2026, their results looked completely different. Not because one had better education, more experience, or access to secret Wall Street information, but because one of them believed something millions of people still believe today, that building wealth requires complicated strategies, endless research, and constant portfolio management. So, the first investor spent years building what experts call the perfect diversified portfolio, buying international stocks, emerging markets, gold, real estate funds, utilities, and several fast-growing technology companies, checking financial news every morning, tracking charts every week, constantly adjusting positions and worrying whether he was making the right moves. While the second investor did something so boring it almost looked irresponsible. He picked one single ETF, invested the same $100,000, closed the laptop, ignored the market completely, and simply moved on with life. Then, something shocking happened. By May 2026, the investor who worked harder lost badly, while the second investor quietly turned that same $100,000 into nearly $500,000 by doing almost nothing. And this reveals one brutal truth about investing that most people refuse to accept. Complexity does not automatically create wealth, time creates wealth. Yet, people continue believing simple strategies cannot possibly work because they feel too easy. But legendary investor Warren Buffett once said, "Diversification is protection against ignorance, and makes very little sense if you know what you are doing." And that raises an interesting question. What if tomorrow every financial influencer disappeared, every stock prediction vanished, and you were forced to choose just one ETF for every decade of your life, nothing else? Because here is what most people never understand. The best investment strategy changes as you age, not because the market changes, but because your relationship with time changes. When you are in your 20s, your greatest financial advantage is not money. It is pure time itself. And time allows you to survive volatility in exchange for massive long-term growth, which means your 20s should never focus on safety or dividend income. They should focus on maximum growth, and this is why funds like SCHG become incredibly powerful, because they focus on the companies building the future, companies like Apple, Nvidia, Microsoft, and Amazon. And historical performance from 2017 through 2026 shows returns close to 19% annually, meaning $100,000. Quietly became almost $500,000 simply by doing nothing. But then life changes and your 30s arrive. Suddenly responsibilities become heavier, mortgages, family, bigger financial commitments. And now a major market crash feels different because real-life pressure exists, which means extreme growth concentration becomes slightly dangerous. And this is where funds like VOO become powerful, because now, instead of depending heavily on a few growth companies, you own 500 of America's strongest corporations spread across multiple sectors: technology, finance, healthcare, consumer goods, industrials, all working together as one giant machine, quietly compounding wealth while reducing risk compared to pure growth investing. Then your 40s arrive, and this is where many investors unknowingly face a dangerous problem called concentration risk, because by now your portfolio has grown large enough that losing a large percentage becomes emotionally painful. And history shows market leadership eventually changes, meaning no single sector dominates forever, which is why broad exposure funds like VTI become extremely valuable, because now you own nearly the entire American economy itself. Thousands of companies, large cap, mid cap, small cap, everything together, automatically protecting you if big technology companies stop dominating the market over the next decade. But now your 50s arrive, and investing suddenly becomes psychological because retirement finally feels close enough to create fear. People begin watching economic news obsessively. Every recession headline creates anxiety, and millions make one huge mistake. They abandon growth too early and move into dividend traps or cash. Believing safety is now the only priority, but what most people forget is retirement money still needs to survive for decades, and this is why dividend growth funds like VAG become important, because instead of chasing high payouts, they focus on financially healthy companies strong enough to increase dividends year after year while still delivering long-term growth. Then, eventually, your 60s arrive, and now the game changes completely because the goal is no longer becoming rich. Now the goal becomes protecting everything you spent decades building while generating enough income so you never need to sell shares during bad markets. And this is why funds like SCHD become powerful, because now your investments begin acting like a personal income machine, producing consistent cash flow through companies with strong balance sheets and reliable dividend history. But here comes the statistic. Most people underestimate. Millions of people now live much longer than previous generations, meaning retirement can easily last 20 or 30 years. And if your money runs out first, the consequences can become devastating, which brings us to your 70s, where the entire objective becomes reliable income every single month, regardless of what markets do. And this is where income-focused strategies like JEPI become attractive, because now your portfolio must prioritize predictable monthly cash flow rather than aggressive growth. But beyond every ETF, every percentage return, and every strategy discussed here lies one truth more important than everything else combined. The greatest threat to your financial future was never inflation, never recessions, never market crashes. The greatest threat has always been your own behavior, panic selling during downturns, constantly switching strategies, chasing trends after prices explode, listening to financial influencers promising unrealistic returns, abandoning long-term compounding before time could do its work. Because in investing, the people who quietly build extraordinary wealth are rarely the smartest people. They are simply the people who stay consistent longer than everyone else. So, the real question is not which ETF gives the highest return. The real question is whether the portfolio you hold today is actually designed for the stage of life you are living right now. Because one decision you make today could silently determine whether the next 50 years of your life become freedom and financial security, or a lifetime of regret watching opportunities compound for everyone except you. Most people underestimate. Millions of people now live much longer than previous generations, meaning retirement can easily last 20 or 30 years. And if your money runs out first, the consequences can become devastating, which brings us to your 70s, where the entire objective becomes reliable income every single month, regardless of what markets do. And this is where income-focused strategies like JEPI become attractive, because now your portfolio must prioritize predictable monthly cash flow rather than aggressive growth. But beyond every